The US economy remains resilient ahead of the biggest week of the year. Indian automakers have a stellar festive season so far, and while the recent weakness in Adobe could be a good buying opportunity. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Oh my God, Stock Doctor podcast. Can't even get the name of my show right. What a start. What a week it was for the US markets, guys. Absolutely. It was one roller coaster week, I have to say, for the US markets. Not only did the week of reckoning for the big tech especially spring up some interesting surprises, but we also got some very intriguing economic data that sets the stage up beautifully for the Fed meeting next week. And then you have, I've been telling this multiple times, you have what I call the event of the year as far as the US is concerned, and that is the US elections, which takes place on Tuesday. I've actually requested, time off, half day off on Wednesday, given that I will be having zero sleep on Tuesday, all-nighter it is for me. So already decided, thankfully I don't have any teaching. Meetings have all been set for the late afternoon because I was like, nope, I don't think I would be in a functioning state early morning Wednesday. But anyway, now you know US elections taking place on Tuesday, and you'll have more of that in the next week's episode for sure. While in all likelihood, we will not know the winner of the US elections on Tuesday night, Wednesday for pretty much every other country, given the fact that there's a massive time difference, and given the fact how tight the race is between the two candidates. There is also, if you if you take into account the potential legal challenges that could be coming, no matter who loses, it just adds to the confirmation that we might not get the actual result for days on end. But it still sets up for a very, very important week as far as the US is concerned. Everything except for elections and the Fed will be taking a back seat. I guarantee you that. So it was fitting that earnings got all the spotlight last week. Well, not all, but majority, given the fact that big tech is, 4 of the sensational 6 reported. As for markets and US investors are concerned, I want to say there's definitely nerves all around. The markets have already started to become a lot more volatile than they were before. And also, given the fact that markets are positioned for a victory for Donald Trump, a Kamala Harris victory would be very bad in the short term, at least for the markets, right? Because when you're positioned in a certain way, when all the institutional investors and the algos and everyone is positioned for one way, when the other outcome is the reality, then clearly things are not going to look well. As far as the market performance this week, once the dust had settled, the markets again ended the week in the red. I did tell you, so much volatility these days. Big tech did not live up to expectations. More on that later. The Dow was down 0.2%. S&P 500 was down 1.4%. And the tech-heavy NASDAQ was unsurprisingly, because I already said it's not a good week for the big tech, finished the week down 1.5%. So, without further ado, let me welcome you to the first segment of the show, which is the Doctor's Weekly Snapshot. And let me do that by dissecting a trove of economic data that we got before moving to the big tech earnings. I did tell you that big tech earnings, well, they got the spotlight, but it was not 100% attention was given to them. There was a bit of an attention split from investors, given the fact that we did get some economic data, a lot of economic data heading into the big week. Let's start with the US economy, which just continues to be incredibly resilient no matter what you throw at it. This was evident from the latest GDP data, the third quarter GDP data, which actually saw the economy grow at 2.8% annual rate, that is, after adjusting for seasonality and inflation. While the figure was lower than the Q2 growth rate of 3%, the annual growth rate of 3%, and it was also below expectations of 3.1%, it just goes, the fact that we got a positive growth and the fact that we got a 2.8% growth just shows how incredible the US economy has been, despite going through a sustained period of high borrowing costs. Keep in mind, remember, you will know that this particular segment is all about context this week. Okay, so keep in mind that when the Fed started raising rates aggressively after their transitory debacle, they decided to go the other extreme and decided to raise rates aggressively. Everyone and their grandmothers were absolutely certain that a recession is coming. Not even slowdown, straight to a recession. all predictions, all the experts and so on were like recession is imminent. That recession, the prediction of which began 2 years ago, has still not materialized. And while some of these experts continue to claim that a recession is a matter of time. I mean, you had a PwC survey of CEOs who think that recession is imminent in the next 6 months. I don't know what to say about it. Even after the Fed has cut rates, what I'm trying to say is, even after the Fed has cut rates, there are people who are still calling for a recession. It has been more than 2 years that we've been waiting for this. I strongly believe that we won't be getting one. Yes, I may be jinxing it. Absolutely. Completely. I am a superstitious individual, could be jinxing it, but I just don't see any red flags that suggest a recession is imminent, let alone in 6 months. The US consumer may have turned extremely cautious. I've talked about this on the show multiple times. The era of price increases may be over. Just ask the restaurants such as McDonald's, Starbucks, all of those guys, and they'll tell you that era of price increase is over. But the spending from the US consumer has simply not gone away. The consumer is definitely facing price pressures, especially in the lower income category, something I raised in the last episode. But the spending, once again, I repeat, the spending has simply not gone away. Credit card delinquencies may be rising, as evidenced from the big bank earnings. Again, if you go to last week's episode, you'll know what I'm talking about. But again, the delinquencies are also not happening at a rate that would suggest that a recession is coming or a recession is imminent, or however you want to call it. And then, so that's the GDP front. And then you have the labor market, which at one point people were certain were on the cusp of breaking. It was on the cusp of breaking. Even the Fed was one of these people, might I add, as evidenced by their decision to go gung-ho on their first rate cut for the whopping 50 basis point cut, rather than the traditional, let's ease it down, 25, 25, 25. But they got really worried with the labor market and they decided to go, you know what? Nope, we're going 50. But what is surprising is after some bumps, and that included the period when the Fed was deciding how much do we cut, the labor market in the US continues to roar. On Wednesday, we got some private hiring numbers, which showed that the private sector added a whopping 233,000 jobs in October. Again, let me give you some context. You will understand why why I say the word whopping. The reason I say it is because not only did this figure smash September's figures of 143,000 jobs, but the figure was actually near double of what economists were expecting. So expectations were put to shame. They were absolutely, it just blew the ADP payroll just blew things out of the water. Okay, part of the surge can be attributed to the essential emergency work, which was made necessary due to the hurricane relief. Remember, you did have massive hurricanes. But ADP's chief economist, and it is ADB ADP who releases these private roll numbers. So the chief economist did say that even if one were to take the hurricane relief out of the equation, the numbers would still stay strong. And then on Friday, we got the October jobs report. We got the non-farm payrolls October jobs report. And again, if you take it out of context, it would look like the labor market on Wednesday was completely fine, but by Friday it was broken and the US is doomed. Here's the case. According to the report, the US economy added 12,000 jobs in October. Yes, I'm not making this number right. I'm not making up this number. Excuse me, I didn't get a zero wrong. All I'm saying, it was a meager 12,000 jobs that were added. Not 120,000. I didn't get the zero wrong. It is 12,000 jobs in October. When you look at September, the US economy had added 223,000 jobs. So one can easily get terrified. Add to it that it also came below economists' expectations of 100,000. You have 12,000 reality, expectations 100,000. Now you go the other extreme. Right? ADP roll was smashing economists in a positive expectations in a positive way. That's great. This smashed economists' expectation in a negative way. Not so great. But again, context is important. What happened in October? Let's take a look at it. Let's take a real look at what happened in October. You had massive hurricanes, right? Helene and Milton, who together wreaked so much havoc that thousands of people were out of work across the Southeast. Then you had the machinist strike at Boeing, which continues to carry on and is going very strong, and that too sidelined individuals. When you combine these external factors that are, they're outliers. I can't even call external factors. They're pretty much outliers at this point in time. You can clearly see why 12,000 number is not an accurate reflection of the US economy. Let me give you more evidence, not advice, evidence to calm your nerves. Despite this dismal figure, unemployment rate remained steady at 4.1%, and wages were on the rise as well. Average hourly earnings were up 4% year over year, slight increase from September when wages rose 3.9% year over year, and that tends to be generally good. Now, one can easily get confused. You could clearly think I'm making this all up just to manufacture a bull case scenario for the U.S. economy. I'm not doing that. Clearly, unemployment figure, you would look at it. Why is it steady? And then you go have 12,000. So I'll explain. I'll explain why there's a discrepancy there, or why I am not crazy. One, let me put on my metaphorical academic hat. Okay. Imagine the hat. I don't have a hat here, but I will wear the academic hat and basically tell you that unemployment rate is based on a separate survey of households. And those who say that they were not at work due to bad weather but still had jobs were counted as employed. The same goes for people who are on strike. So again, they may not be working, but they have a job. So that's counted as employed and not unemployed, which clearly shows the difference between the unemployment rate being steady and the actual jobs figure being an absolutely dismal figure, if you want to call it. Academic hat taken, kept it on the side. I should really invest in a hat just to sell the point. But here we go. So just because of this difference, you could clearly say, just because of the way the unemployment figure is calculated, therein lies the difference. And in other words, put simply, the underlying message is that the labor market continues to be resilient, and the October jobs figure will have to be taken with a lot of context. If you want to take the theme of Doctor's Weekly Snapshot this week, it is take everything in context. Should call the segment that. Finally, I cannot wrap this segment without talking about the big tech earnings. 4 of the sensational 6 reported last week. Microsoft, Meta, Amazon, Apple. While the numbers were incredible for the quarter gone by, for these giants, the guidance was simply not up to expectations, which disappointed investors. And that explains the Nasdaq stumble of 1.5%. I've told you guys time and time again when it comes to big tech, especially when it comes to the sensational 6, simply meeting expectations has never been good enough for these stocks. They have to keep blowing out of the water, which is quite a challenging proposition if you ask me. I'm not going to go into the earnings individually because you will meet some of these earnings one by one on the Dr. Dissect segments in future episodes. But I will talk about the one theme that you could take away from the big tech earnings. And that is the sensational 6 have absolutely no plans to rein in spending when it comes to AI. In other words, the belief in the AI revolution continues to be strong as ever. Microsoft and Meta Platforms, parent company of Facebook, are the 2 companies that are on hyperdrive mode when it comes to AI spending. Let me give you some figures to justify this. And I would like to thank Wall Street Journal. They didn't tell me to thank, but I am thanking them for the data, for these figures that I'm about to give you. Microsoft's average capex spend between 2014 and 2023, so a 10-year period, stood at 12% of the company's revenues. In 2024 alone, Microsoft has ended up spending $53 billion in capex, which actually represents 28% of the revenue. You have a 10-year average, it's at 12%, and then you have a single year, 28%. You know that company is on hyperdrive mode. Let that really sink in. 12% 10-year average, 28% of the revenues, single year, and the year is not even done yet. Meta is not far behind either, by the way. In the past 10 years, Meta's average capex spend was about 19% of the revenue. And this includes the madness that was metaverse. Even the lights in my office, couldn't believe that figure, so they had it turned off. There is a little bit of problem there. Anyway, Meta's average spend was 19% of the revenue, and it includes the madness that was metaverse. In 2024 alone, it plans to spend between $38 and $40 billion in capex, which represents 24% of the company's projected revenue for the year. While not as crazy as Microsoft, the numbers are still bananas. There is no doubt about it. Cuckoo, banana, however you want to call it whatever other synonym you want to call for craziness, that Microsoft and Meta's figures are just mad. Okay, Alphabet and Amazon, the other players in the race, are also spending significant numbers and significantly on capex. But when you compare their 10-year average, they're marginally higher. In Amazon's case, it's actually in line. So you can clearly see why Microsoft's and Meta shares suffered post their earnings report. You have gigantic spending, but your guidance barely meets expectations. That's just a recipe for disaster if you belong to the sensational six. Microsoft and Meta, like I said before, were the primary drivers of Nasdaq's weekly decline. The good news is that the AI spend does seem to translate to revenue growth. For instance, Microsoft saw a very, very strong performance in Azure, its cloud division, much higher than street estimates, and AI contributed to 12% of Azure's growth, significant rise from the 8% contribution that it made in the previous quarter. Meta said that its AI tools are helping advertisers, and AI is directly leading to an increase in conversion rates by the tune of 7%. The proof is there, but given these contributions are not mouth-watering or mind-blowing, it's a worry for investors. Does that mean that these companies should stop spending? Absolutely not, because unlike the metaverse, and you've heard me say it again multiple times, unlike the metaverse, AI is here to stay and is set to revolutionize the world. So don't expect the spending to stop anytime soon. And you will find mouth-watering figures coming your way in each episode in the coming weeks for sure when it comes to AI. Right. You had US economic data and you had the big tech earnings. What do you make of all this? That's the question, right? Simply reading numbers not enough. What do you make of it? One thing's for sure. Earnings will definitely take a backseat next week. It's absolutely certain, and the US economy will be once again at the forefront. For markets, they will look at the Fed. But given that it's happening the day after the US elections, it's going to be a week of volatility. They're going to react to the earnings. The markets are going to react to the earnings on Wednesday, and then they're going to simultaneously react to both the elections and the Fed decision on Wednesday's trading session. Okay, so as the Wednesday's trading session comes to an end. Okay, so it's going to be, it can go either way. All right, so volatility is pretty much guaranteed. For the long term, I see less cause for concern. The US economy is on a very strong footing. Big tech earnings were not a disaster as far as I'm concerned. In fact, they were solid. And given that the Fed has started to cut rates, a recession is very, very unlikely. I still say unlikely. I'm not saying it's impossible. But do I expect the markets to have a positive time in the coming days? Absolutely not. The coming weeks would be a dream for an options trader. So if you were trading options, this is the dream, because I do expect markets to be extremely volatile. And volatility means options trading is amazing. It's fantastic. So if you're an option trader, this is the week for you. The direction of the market will be extremely hard to predict for sure. I mean, the expectation is that the market post the US elections would be, the magnitude of the change in the markets would be 2.8% on average. But whether it goes 2.8% up or 2.8% down, we don't know. The direction is still not known. Not known. Would I buy stocks this week? Extremely unlikely, simply because I would let the volatility play out before deciding. I do have a list of stocks, don't get me wrong. I do have a list of stocks that I'm definitely keen on either adding, as in buying more of it, or taking a new position in. But this week is not the time. This week is for investors to take up meditation practices if you're not doing it already. But if you are doing it, then probably meditate a lot more regularly and try, or at least pretend to try, and relax. Choppy waters are pretty much guaranteed, ladies and gentlemen. So the goal should be demonstrating tremendous restraint, not to panic buy or panic sell. Brace yourselves is all I have to say. With that, I would like to welcome you to the next segment of the show, The Doctor Goes Home, where we go all the way from US, my home in India. So welcome to the Doctor Goes Home segment, and this week's theme is all about automakers, because a new month means yet another segment of discussing India's auto sales numbers. If you haven't noticed, okay, I don't know how many of you have invested in automakers, autos. I'm a big time auto investor in India. But if you haven't noticed, then let me tell you that shares of automakers have been on a downward trend in recent days. So not very happy times for me as far as my Indian investments are concerned. That's because of a twin shock of massive inventory buildup, as well as companies having to offer deep discounts to get rid of the excess inventory. Okay, it's not twin shocks if you think about it. It's just one issue, given the fact that both of them, the inventory buildup and then using heavy discounts, they're pretty much linked, right? So you could say one shock. twin shocks, however you want to call it. I'm just going to say it's this one overarching issue that's bothering all the Indian automakers. Okay. The good news is that the things might be starting to look on the up again, thanks to a stellar festive season. For passenger vehicles, SUVs have been a blessing as they have continued their positive momentum despite all the other negatives. PVs in October, many of them actually reported record SUV sales for the month. Overall sales in October 2024 were flat year over year, but the good news is that the festive season has been a very strong catalyst. If you listen to management commentary on the October sales, it simply says the festive season has been strong. The question then becomes, is whether this uptrend that you are likely to see in the coming months, whether it's a one-off caused by seasonality, or whether it can be the foundation upon which sales can really start to roar again. Let's go to the top car makers individually now. India's largest car maker, Maruti Suzuki, had a stellar month, recording its highest ever monthly sales, with sales jumping 3.6% year over year, coming in at a little under 206,450 units. Company had yet another positive month for exports, registering its highest ever monthly exports of 33,168 units. This is actually a positive news given that automakers had to resort to pretty deep discounts to woo the Indian consumer. And now that the company has also started the export of its SUV Fronx, the export should see continued growth, in my opinion. On the earnings front, Maruti had a pretty disappointing Q2 report, with profits falling 17% year over year and revenues barely showing any growth. The festive season has been very good for India's top car maker, although it would be really interesting to see how the deep discounts that it had to offer in order to make the festive season good enough, how it would affect its Q3 margins and profitability. That is the question that if you're an investor of Maruti, you need to really consider. Second largest car maker, Hyundai Motor, which actually went public. You can now publicly buy shares in Hyundai. I'm a buyer. I've invested in the IPO. Just want to say, it went public a few days back. Had a pretty muted sales performance in October. October sales were essentially flat, although the company did register its highest ever monthly SUV sales, primarily driven by Creta. SUVs represent 68% of the company's monthly sales, but it all depends on how the company's latest models will fare. I invested in Hyundai IPO, like I told you before, since I continued to believe in the company's long-term growth prospects. But I must admit, the short-term path looks bumpy for sure. I'm also questioning whether it was the right time for the company to go public, especially at a time when investors had just turned sour towards automakers, towards Indian automakers, and especially because of the demand taking a hit. Given that the SUV craze is still going strong, it is my opinion that things should start picking up for this company. Would I invest more in the name at this point? No. I still think there's weakness to be felt in the shares. So probably I am biding my time. Probably biding your time is the best course of action. I'm certainly biding my time before I add more to the position. If I see significant weakness up to a certain point, I'll consider, because long-term prospects, in my opinion, are good. But then again, you do your own investment research. I have to put the disclaimer here. Moving on to Tata Motors now. Again, not a great October for the EV leader. The domestic PV sales decline in October. The company is facing some serious competition from the likes of Mahindra & Mahindra and Hyundai, and it had to resort to deep discounts as well to ensure that the festive season would be good. The company's EV offerings continue to gain traction, but given the competitive landscape and given that hybrids are starting to gain more popularity, it is vital that the company's new offerings stand out. This is certainly a must-watch story, especially if you have invested in the name like me. The stock's already down 9% in the last 1 month and had a week to forget, with shares tumbling 3%. Overall, in my opinion, the shares are finally starting to get a little bit more attractive than where they were before. But given the negative sentiment surrounding automakers, I simply wouldn't go all in on the name yet. You got to consider the hybrid threat as well, right? Nobody was talking about hybrid threats when Tata Motors was releasing its EV. It was all EV, EV, EV. But now the hybrid threat is real. Finally, there's Mahindra & Mahindra, my other investment in the auto space. Like Maruti, M&M also recorded its highest ever monthly sales in October, with sales just simply continuing their positive momentum. And that's bad news for Tamo. Sales jumped 20% year over year for M&M. The SUV maniac is clearly offering some significant tailwinds for this auto giant, as the company recorded its highest ever SUV sales of 54,505 units in October, which translates to an impressive year-over-year growth of 25%. The company's latest SUV model, the Thar ROX, saw a significant uptick in bookings. It simply rocks, is what I have to say here. A little bit of dad joke there, garnering 1.7 lakh bookings inside the first 60 minutes. And it is clear that the festive season, along with the SUV mania, have clearly aided the company's growth. The company shares have definitely taken a hit recently in sympathy with other automakers, with shares down 9.7% in just 1 month, although they are still up 66% year to date. So there has been significant money that's been made in this year from Mahindra and Mahindra. Okay, let's move on to the two-wheelers now. Hero MotoCorp had an absolutely amazing month. Sales jumped 18% year over year, with motorcycles accounting for the majority of the growth. Exports were yet another attractive element in October for the name, as they jumped 43% year over year. The company fully plans on capitalizing on the tremendous growth seen in its motorcycle segment, as it plans to launch new models in this particular segment. The festive season has been very kind to India's top two-wheeler, but it's all about maintaining the momentum. We don't look at the past when we're investors. We acknowledge the past, but we look forward to the return to the future, because that's how we make money in the markets, at least. TVS Motor continued its growth trajectory, with sales jumping 13% year over year, with the motorcycle, scooter, and EV segments all contributing to the overall sales growth. October belonged to TVS's EVs. So on a TVS, just on the TVS perspective, the EV segment shined the most. Sales surged 45% year over year. The scooter segment also showed some impressive growth of 17%. Even exports continued their positive momentum, jumping 9% year over year. Royal Enfield, surprise, surprise, had a positive month as well, with bike sales jumping 31% year over year, and exports actually being a very surprising growth driver. Royal Enfield had a few months to forget. If you recall all my all my commentary on the Indian automakers, I always used to say bad month for Royal Enfield, bad month for Royal Enfield, bad month for Royal Enfield. So this is a very much surprise, and especially as exports were so bad in the past. They seem, I don't know whether it's a one-off or whether they've turned things around, but let's see. Finally, my latest investment, Bajaj Auto, had a fantastic month as far as EVs are concerned. It managed to sell 30,566 units of Chetak, which translates to a year-over-year growth of 211%, marking the highest ever retail sales of the model for the company in a single month. So the EV mania has clearly hit Bajaj, and it has been an absolute blessing and a tailwind for the company. Bottom line, I did tell you a few months back that the festive season would be ever so crucial for the car makers, after sales registered a rare dip year over year way back in July. Thankfully, the festive season appears to have been a solid tailwind, which would bring some much needed relief, not just to the OEMs, but also to the dealers who've had to deal with massive inventory buildup. If SUVs were the driving force for PVs, then electric vehicles, along with exports, have been a major blessing for the two-wheelers. Now, here I have to take a step back and just talk about what is going on with Ola Electric. I'm an investor in Ola Electric, and I continue to believe in its long-term prospects. But frankly, my patience is starting to wear off thin when it comes to the company, especially when it comes to its founder, Bhavish Aggarwal. I think Mr. Aggarwal needs to focus on the business rather than getting into social media battles with some comedians who are pretty good at riling you up anyway. I mean, I just don't see the point. Mr. Aggarwal, you're not Elon Musk. Okay, while you're spending time dealing with petty squabbles, your competitors are fast catching up, as seen by the tremendous growth in the EV segment for both TVS and Bajaj. As an investor, I had to say this, so that's that. I've already invested in TVS and Bajaj as well, so net, it's still okay for me. But I mean, either Ola, rolls up its sleeves and gets better, or I'm out of the name. Simple as that. So I'm going to stop it there. I just needed to bring it out because I'm getting pretty sick and tired of reading stories of Mr. Aggarwal and this battle with this comedian. Overall, coming back to the overall element, the question remains whether the festive season was simply a mirage or whether demand is once again coming back. The answer to this will become clear in the coming months, which would decide the future trajectory of the shares of the automakers. It has been an amazing ride for them, but they are starting to hit some serious major bumps. Watch this space with caution if you're planning to invest, although I must say, I'm going to end the segment by saying the share prices of some of the major players are finally starting to look very enticing. And with that, I'd like to welcome you to the final segment of the show, Dr. Dissects. Right. In the Dr. Dissect segment, I'd like to talk about Adobe this week, ticker ADBE. It makes a return on the segment simply because I need to give you guys an update on its AI initiatives. And a disclaimer, I am an investor in Adobe. I have shares in Adobe. Whether I will buy more or not, let's wait till the segment is over. There has been considerable debate about companies' ability to make money from their AI investments. Make no mistake about it. I mean, you already saw the big tech earnings and you already know this, right? Investors get a little jumpy when companies spend on AI and their revenues don't match the investors' expectations, at least. Okay, very, very fickle there, I have to say. And Adobe's case has been no different as investors continue to question the impact of its AI tools on future profitability. The last time I talked about Adobe, I did offer you guys evidence on how the company has firmly laid the foundation to monetize its AI tools. In the most recent quarter, we got even more evidence on Adobe's monetization efforts, and it involves something called generative credits. Academic hat back on. Generative credits are how users can deploy Adobe's Gen AI features powered by Firefly in any of the company's applications that the user has subscribed to. Depending on the generated output's computational cost and the value of the Gen AI feature that the user has deployed, the user consumes these credits. Hat out, investor back in. For now, the company has not instituted any caps on the amount of generative credits which a user can consume. As the adoption of Firefly accelerates, which is something the management noted during the most recent quarter, the company plans to issue caps on generative credits, beyond which users will most likely have to pay for them. Management is already seeing a higher rate of consumer retention for the products that have Gen AI features, which has subsequently accelerated the consumption of generative credits. This does suggest that the demand is there, and therefore, as Firefly becomes more widely used, which is inevitable in my opinion, given how effective the tool has been, monetization via generative credit could happen a lot faster than anticipated. The company's AI tools have already led to increased demand for its products, as evidenced by the strong growth in both the creative and the document cloud segments in the most recently concluded quarter. In a way, the AI tools are already having an indirect impact on the company's top and bottom lines, but the problem is investors always need direct impact. Sometimes it's about indirect impact as well, guys. Sometimes it is about indirect impact as well. It doesn't have to be all direct at all. Introducing caps on generative credits would lead to these tools directly impacting both the revenues and earnings, thereby opening up an entirely new source of earnings growth. There's also the company's generative AI video creation tool dubbed the Adobe Firefly video model, set to be launched later this year. The model, which you can set to compete with the likes of OpenAI's Sora, would be an area where users would consume a substantial amount of generative credits, especially since it's designed to be commercially safe. Assuming that the Firefly video model also sees strong demand, a realistic scenario, in my opinion, especially since the likes of Sora have been subject to ethical and legal concerns in the past, Adobe's text-to-video generator could be a massive catalyst for the company's efforts to monetize its AI tools via generative credits. It's too early to say what extent these monetization efforts would contribute to the company's earnings growth. However, unlike some of its peers, Adobe at least has a blueprint to directly monetize its AI tools, and that can only mean good news. Now, when Adobe released its earnings report, shares actually, the stock fell nearly 11%. Okay. And the reason why it fell 11% was because of its softer than expected Q4 guidance. However, when one digs a little deeper, the soft guidance can be perfectly explained by a couple of factors. One, management mentioned that some deals which were expected to close in the fourth quarter closed in Q3, clearly having a negative impact. Second, traditionally both Black Friday and Cyber Monday occur in the fourth quarter. This time they are being pushed. Cyber Monday will fall in Q1, which implies that those revenues would actually occur in the first quarter of 2025, FY25, as opposed to the fourth quarter. So it's a matter of delay rather than deny, or rather delay rather than forget, or delay rather than, destroy, or however you want to put it, right? It's a simple case of timing. Cyber Monday just falls on Q1 instead of Q4 last year. So obviously on a comparison basis, it's going to be a problem. So it's timing issues that have led to a soft Q4 guidance. But although I've got to say, although the guidance was soft, it was still the highest target that the company has ever issued. like the guidance, the range of target, it's the highest. So I don't see the problem here, but clearly investors do, and Adobe's shares have not been faring well so far, which is why I'm saying I might be looking to buy more into the name. When one looks into the overall business of Adobe, the company's divisions are firing on all cylinders. The demand for both creative and document cloud segments continue to remain strong. More specifically, revenues from the Creative Cloud grew 11% year over year in constant currency, and its ARRs grew to $13.45 billion in the most recently concluded quarter. During the same period, Document Cloud saw its revenues grow 18% year over year, and ARR for this segment stands at $3.31 billion. Then there is Adobe Express, which continues to show strong growth. The last time I talked about Adobe, I mentioned how Express can allow Adobe to be a leader in AI-driven marketing. In the most recently concluded quarter, we got more ways through which Express is adding value to Adobe. The company recently launched Express for Enterprises and Express for Education, the last of which comes at an opportune time given that we are in the back-to-school season. These launches allowed the company to onboard over 1,500 businesses and millions of students, a significant universe of prospective clients who can continue to drive the company's growth. The company at the same time is also seeing significant uptick in free-to-paid conversions thanks to its Google Chrome and Microsoft Edge extensions. All of the developments that I just talked about, along with other achievements such as record RPOs, demonstrate that the company's fundamentals remain firmly intact. As such, in my opinion, the reaction to the soft Q4 guidance was clearly overdone, especially since it was a matter of timing and had nothing to do with any structural weakness. Time to take my notebook out because we are going to talk about valuation. Now, the company expects non-GAAP EPS for Q4 to come in between 463 and 468. Okay, Q4 diluted non-GAAP EPS to come in between 463 and 468. There is a lot of reason, in my opinion, to be optimistic about the odds of the company beating or at least matching the high end of the guidance. For instance, the Document Cloud segment, the usage and monthly active user growth via the likes of Google Chrome and Microsoft Edge are driving free-to-paid conversions, which should boost the bottom line. The demand for Adobe Express continues to remain strong, and the company is seeing an uptick in the number of users upgrading to higher value creative plans within this segment. Finally, the company's strong RPO should be a catalyst for future earnings. Taken things together, so when you take all these positive catalysts together, I have assumed Q4 non-GAAP EPS to be the high end of the guidance, which is $4.68. So I've assumed high end of the guidance, that's my assumption, is $4.68. When under this assumptions, total non-GAAP EPS for FY24, total non-GAAP EPS for FY24 comes in at $18.29. $18.29. Okay. Adobe currently trades at a forward multiple of 26 times, according to LSEG data, formerly Refinitiv, which is similar to where some of its peers, such as Salesforce and Oracle, are currently trading at. However, other peers, such as Autodesk and SAP, trade at higher multiples. Adobe also currently trades cheaply to its own historical levels, with its 5-year median forward PE and its 10-year median forward PE being 31.3 and 31, respectively. Last time I valued Adobe at 31.3 times. I've assumed the same multiples for my calculations this time as well, since I believe that the company's catalyst for the earnings growth remain intact, despite the lower than expected guidance. Furthermore, the company in FY24 is on track to achieve a year-over-year earnings growth of 13.74% in line with its long-term earnings growth. This further justifies my the higher multiple, in my opinion. So, forward PE assumption is 31.3x. 31.3x, that's my assumption for forward PE. According to Seeking Alpha, the company's price to earnings to growth ratio stands at 1.66, lower than the industry median of 1.9 and its own 5-year historical average of 2.21. At a forward PEG ratio of 1.66 and a forward PE of 31.3, FY earnings growth would be 18.85%, much higher than its long-term growth, as well as its trailing 5-year CAGR of 16.22. With the uncertainty surrounding profitability from its AI products, an earnings growth of 18.85% is too optimistic, in my opinion. At a forward PEG ratio of 1.9, the industry median, however, FY25 earnings would be 16.5, a more reasonable estimate, in my opinion, and in line with trailing 5-year CAGR. The lights believe so. So, what I have done is I've basically taken an earnings growth, writing it as we speak, of 16.5%. And if I were to take it this earnings growth, you get FY25 EPS of 20.97. Okay, FY25 EPS of 20.97, growth rate assumed is 16.5%. Okay, now, so all you need to now then do is take 31.3x, multiply that by 20.97, and you get a price target, ladies and gentlemen, of $667. So 31.3 times multiplied by 20.97, $667 is the price target that I'm getting, which is which represents an upside of about 38% from current levels, and is also higher than my previous price target of 656. And therefore, ladies and gentlemen, I am maintaining my rating on Adobe stock as strong buy. The pen was not working very well, so strong buy. Okay, so 667 price target, strong buy on the stock, so much bull case, got to talk about the risk factors, correct? Despite the announcement, and the risk factors are, despite the announcement of Firefly video model, the company continues to face strong competition from the likes of OpenAI and Runway. Part of my bull case relies on the video model becoming a success, subsequently boosting the potential to monetize its generative credits. Should the likes of Sora and Gen 3 Alpha outperform Adobe's video model, Firefly video model, then the potential for generating earnings growth through this channel could take a significant hit. Furthermore, the timing of AI monetization also remains a mystery. Management during the recently concluded earnings call did mention about instituting caps on generative credits, like I mentioned before, but simply did not offer any timeline on when this would happen. A prolonged delay in implementing the strategy, either due to weakening demand or increasing competition, could also have a negative impact on future profitability. Bottom line, the biggest highlight from the most recent quarter of Adobe's most recent quarter, was the progress made on monetizing its AI tools. Management during that quarter also offered yet another way through which the company plans to directly monetize its AI tools. Generative credits have the potential to be a new source of revenue and earnings growth. Given the demand seen for its AI products, instituting caps on generative credits would allow the company to directly monetize these tools, which would subsequently boost its future earnings. From a valuation perspective, the company looks even more attractive at current levels, especially after the post-earnings sell-off and then the subsequent negative sentiment that the stock has been facing. Adobe, in my opinion, continues to be a major AI beneficiary for the long term. One potential soft quarter is not going to change that. That's all the time I have for you this week, ladies and gentlemen. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. If you're going to stay up with me on Tuesday night, all the best to you as well. Make sure you drink lots of coffee or any other caffeine products. See you next week with more, definitely with more news on the election and the Fed front. Until then, stay safe and make some money.